I need to tell you something that's keeping me up at night. Something that most people aren't paying attention to. Something that could destroy billions of dollars in wealth starting as soon as March of 2026. I've spent the last 18 months analyzing balance sheets, stress testing scenarios, and running models on the banking sector, and what I'm seeing terrifies me. We're heading toward a banking crisis that could make the regional bank failures of 2023 look like a warm-up act. And the trigger, the catalyst that could set everything in motion, it's coming in March. Now, I know what you're thinking. Michael, you've been warning about crashes for years. You're always predicting doom. And you're right to be skeptical. I've been early before. Being early and being wrong can feel the same when you're watching the market go up while you're sitting in cash or holding short positions. But here's what people forget. I was early on the housing crisis too. I started shorting subprime mortgages in 2005. The crisis didn't hit until 2007 and 2008. I endured 2 years of investors telling me I was wrong, of quarterly letters explaining why I still believed in my thesis, of watching my fund's performance suffer while everyone else was making money. And then I was vindicated. Scion Capital made over $700 million on those bets. My investors who stuck with me made returns of over 400%. I'm not telling you this to brag. I'm telling you this because what I'm seeing now in the banking sector has the same patterns, the same warning signs, the same structural vulnerabilities that I saw in 2005 and 2006. And just like back then, almost nobody is paying attention. Let me take you back to how I discovered what became the Big Short. It was 2004. I was running Scion Capital out of a small office in California. I had always been interested in the housing market because of my background in medicine, believe it or not. When I was in medical school and residency, I saw how the system worked. I saw how institutions create complex structures that hide risk, how they use leverage to amplify returns, and how they rely on the assumption that certain things will never happen. The human body is a system. The financial system is a system, and systems can fail in predictable ways if you understand the underlying mechanisms. I started reading through mortgage bond prospectuses. These were documents that nobody reads. I mean nobody. They're hundreds of pages of dense financial jargon describing the underlying mortgages in these securities. And what I found shocked me. The loans being made were garbage. No income verification. No down payment. Adjustable rates that would reset higher. People borrowing 6 times their annual income. It was insane. But the bonds backed by these loans were rated AAA by the rating agencies. The safest possible rating. The same rating as U.S. Treasury bonds. I knew something was wrong. I knew that when these mortgages started defaulting, the bonds would collapse. And I figured out a way to bet against them using credit default swaps. But here's the thing, and this is important. I was early. I made my first bets in 2005. The crisis didn't happen until 2007. For 2 years, I was paying premiums on these swaps while the housing market kept going up. My investors were furious. They thought I'd lost my mind. Some of them tried to pull their money out. I had to gate the fund to prevent redemptions. It was brutal. But I knew I was right. I knew the math. And eventually, I was proven correct in a spectacular fashion. Now, fast forward to today, 2026. I'm seeing the same patterns in the banking sector. The same structural vulnerabilities. The same assumption that certain things can't happen. The same complexity hiding risk. And I'm seeing a specific catalyst that could trigger a crisis starting in March. Let me explain what's happening. The banking sector today is sitting on massive unrealized losses. This isn't a secret. If you read bank financial statements, you can see it right there in the footnotes. Banks own trillions of dollars in bonds, treasuries, and mortgage-backed securities that they purchased when interest rates were near zero. Those bonds are now worth significantly less because interest rates have risen. When bond yields go up, bond prices go down. That's just math. A 10-year Treasury bond paying 2% is worth much less when new 10-year Treasuries are paying 5%. Banks mark these bonds as held to maturity on their balance sheets, which means they don't have to recognize the losses immediately. They can pretend the bonds are worth their original purchase price as long as they plan to hold them until they mature. This is accounting magic. It's legal, but it's also dangerous because it hides the true economic reality. According to the FDIC's data, U.S. banks are sitting on over $500 billion in unrealized losses on their securities portfolios as of the third quarter of 2025. 500 billion. That's larger than the entire market cap of most major banks combined. Now, as long as depositors don't panic and withdraw their money, these losses stay hidden. The banks can hold the bonds to maturity and never have to realize the losses. But if depositors start withdrawing money in large amounts, banks are forced to sell these bonds to raise cash. And when they sell, they have to recognize the losses. Those losses eat into capital, and if capital gets too low, the bank fails. This is exactly what happened to Silicon Valley Bank in March of 2023. They had massive unrealized losses on their bond portfolio. Their depositors got spooked and started withdrawing money. SVB had to sell bonds at a loss to meet withdrawal demands. The losses wiped out their capital, and the bank failed in 48 hours. $16 billion in market value gone overnight. But here's what most people don't understand. The problem that killed Silicon Valley Bank, it hasn't been fixed. It's gotten worse. Interest rates are still elevated. Banks are still sitting on these unrealized losses. And now we have additional stresses coming into the system. The commercial real estate market is collapsing. Regional banks hold enormous amounts of commercial real estate loans. Office buildings that are 40 or 50% vacant. Retail properties with declining rents. These loans are starting to default. And when they default, banks have to take losses. I've been studying the commercial real estate exposure of regional banks very carefully. The numbers are staggering. There are dozens of regional banks with commercial real estate loans that exceed 300% of their capital. 300%. That means if even a third of those loans go bad, the bank is insolvent. Let me give you specific examples. New York Community Bank. They got into trouble earlier this year because of their commercial real estate exposure. They had to raise emergency capital. Their stock dropped over 70%. But they're not alone. There are banks in Texas, in California, in the Midwest, all with similar exposure, all sitting on portfolios of commercial real estate loans that are underwater. The borrowers can't refinance because interest rates are too high. They can't sell the properties because nobody wants to buy office buildings with 50% vacancy rates at prices that would pay off the loans. So the borrowers are just sitting there, making interest payments if they can, but knowing that eventually they'll have to hand the keys back to the bank. And when that happens, the bank takes a massive loss. Now here's where March comes in. March is significant for several reasons. First, there's a massive wave of commercial real estate loans coming due in March and April of 2026. These are loans that were made 5 or 7 years ago that are now maturing. The borrowers need to either pay them off or refinance them. But they can't refinance at current interest rates because the cash flows from the properties won't support the debt service. And they can't pay them off because they don't have the cash and they can't sell the properties for enough to pay off the loans. So these loans are going to default and the banks are going to have to recognize losses. Second, March is when banks have to file their annual reports. This means they have to do thorough assessments of their loan portfolios and their securities holdings. They have to mark things to market more honestly. They have to disclose problems that they might have been able to hide during quarterly reports. The annual audit process is much more rigorous, and I think we're going to see some very ugly disclosures in March when these annual reports come out. Third, March is historically a dangerous time for banks. Silicon Valley Bank failed in March. Credit Suisse was rescued in March. There's something about the end of the first quarter that seems to expose vulnerabilities. Maybe it's because it's far enough into the year that problems can't be hidden anymore. Maybe it's because it's when annual bonuses have been paid and employees are more willing to blow the whistle. Maybe it's just coincidence. But the pattern is there. I've gone back and looked at banking crises throughout history. There's a clustering of bank failures in March and April. It's not absolute, but it's statistically significant enough that I pay attention to it. Fourth, and this is the big one, the Federal Reserve's emergency lending facilities expire in March. After the regional bank crisis in 2023, the Fed created special lending programs to backstop banks. Banks could borrow from the Fed using their bonds as collateral at par value, not at the diminished market value. This was a lifeline for banks sitting on unrealized losses. They could borrow from the Fed without having to sell their underwater bonds. but these programs are set to expire. And once they're gone, banks lose that safety net. Now, you might be thinking, well, if the Fed sees a crisis coming, they'll just extend the programs. Maybe, but maybe not. The Fed is in a very difficult position right now. Inflation is still a concern. They can't be seen as bailing out banks without limit. There's political pressure. There's moral hazard. If banks know they'll always be rescued, they'll take on more risk. The Fed has to balance financial stability against the long-term health of the system. And I'm not confident they'll make the right choice. I've watched the Fed for decades. They're always behind the curve. They're always reactive, not proactive. They wait until there's a crisis, and then they scramble to respond. By the time they act, the damage is often already done. Let me walk you through what I think is going to happen. We're going to see a triggering event. It could be a large commercial real estate default. It could be a regional bank reporting disastrous annual results. It could be a depositor run at a vulnerable institution. Something is going to spook the market. And when it does, depositors at other vulnerable banks are going to get nervous. They're going to start looking at their bank's balance sheet. They're going to see the unrealized losses. They're going to see the commercial real estate exposure. And they're going to withdraw their money. Not because their specific bank has done anything wrong, but because they don't want to be the last one out. This is classic bank-run psychology. Banks are fundamentally fragile institutions. They borrow short and lend long. They take in deposits that can be withdrawn at any time, and they make loans that are locked up for years or decades. This maturity mismatch works fine as long as everyone stays calm, but once panic starts, it feeds on itself. Depositors see other people withdrawing money, so they withdraw their money, which causes more people to withdraw, which causes the bank to sell assets at fire sale prices, which crystallizes losses, which depletes capital, which scares more depositors, and the spiral continues until the bank fails or gets rescued. I've modeled this out. I've looked at which banks are most vulnerable. I've analyzed their securities portfolios, their commercial real estate exposure, their deposit bases, their capital levels. And I can tell you there are at least a dozen regional banks that are one bad headline away from a crisis. These aren't tiny community banks. These are institutions with $50 billion, $100 billion, $200 billion in assets. If even 2 or 3 of them fail, it's going to shake confidence in the entire system. Now, some people will say, but Michael, we have deposit insurance. The FDIC insures deposits up to $250,000. People won't panic because they know their money is safe. And that's partially true. But here's the problem. Most wealthy people, most businesses, they have way more than $250,000 at their banks. A small business with a $5 million payroll account, they're not fully insured. A wealthy retiree with $2 million in cash waiting to buy a house, they're not fully insured. These are the people who will run first. And in the digital age, a bank run happens in hours, not days. You don't need to line up outside the branch. You just log into your phone and transfer the money to a bigger, safer bank. This is what killed Silicon Valley Bank so fast. By the time management realized what was happening, billions of dollars had already left. They couldn't stop it. The technology that makes banking so convenient for customers makes it terrifyingly vulnerable for banks. I've talked to people inside several regional banks, off the record, confidentially, and they're terrified. They know they're sitting on these vulnerabilities. They know a run could start at any moment. They're trying to manage their balance sheets, trying to reassure large depositors, trying to quietly raise capital without spooking the market. But it's like trying to defuse a bomb while pretending everything is fine. One wrong move and it blows up. Let me give you a specific example of a bank I'm watching very carefully. I'm not going to name it because I don't want to cause a run myself, but this is a regional bank with about $120 billion in assets. They have significant commercial real estate exposure. About 40% of their loan book is commercial real estate. They're concentrated in office and retail properties in major cities. Their unrealized losses on securities are about 12% of total equity. That's manageable, but not comfortable. Their deposit base is interesting. About 60% of their deposits are over the FDIC insurance limit, and about 30% of their deposits are from businesses, not individuals. These are the most flight risk deposits. I've looked at their annual filings for the past 5 years. I've watched their net interest margin compress as they've had to pay more to retain deposits. I've watched their loan loss provisions increase as borrowers struggle. I've watched management try to spin the story in earnings calls, talking about how they're well-positioned and well-capitalized and managing risk prudently. But when I look at the numbers, I see a bank that's one bad quarter away from serious trouble. And they're not unique. There are others just like them. Banks that look fine on the surface but are actually quite fragile underneath. Now, let me talk about why this matters to you, even if you don't have money in a regional bank. Even if you bank with JP Morgan or Bank of America or Wells Fargo. Because a banking crisis doesn't just hurt the banks that fail. It ripples through the entire economy. When banks get scared, they stop lending. When they stop lending, businesses can't get credit. When businesses can't get credit, they can't expand, they can't hire, they can't invest. The economy slows down. We saw this in 2008. The banking crisis turned into a broader economic crisis. Unemployment spiked. The stock market crashed. Housing prices collapsed. It took years to recover. And I'm worried we're heading towards something similar now. Not identical, the specifics are different, but similar in scale and impact. The credit contraction could be severe. I've already seen signs of this. Banks are tightening lending standards. They're rejecting more loan applications. They're increasing rates for borrowers they do approve. Small businesses are having trouble getting lines of credit. This is happening before any crisis. Once a crisis starts, once banks start failing, lending is going to freeze up completely. Nobody will be able to get a loan unless they have perfect credit and enormous collateral. The stock market will react badly to a banking crisis. Bank stocks will collapse, obviously, but it won't stop there. Financial stress spreads. When banks are in trouble, people get worried about the entire financial system. They sell stocks and move to cash or treasuries. We could see the S&P 500 drop 20, 30, maybe 40% if this gets bad enough. Real estate will be hit hard. Commercial real estate, obviously, that's where much of the stress originates. But residential real estate will suffer too. When banks stop lending, buyers can't get mortgages. When buyers can't get mortgages, demand falls. When demand falls, prices fall. We could see significant declines in home prices, especially in markets that have been overheated. I'm not predicting a repeat of 2008 where prices fell 40% nationally, but 10 to 15% declines in many markets seem very possible. And in some overvalued markets, it could be worse. Jobs will be lost. This is the human cost that people don't think about until it's too late. When banks fail, their employees lose jobs. When banks stop lending, businesses fail and their employees lose jobs. When the economy slows, companies lay people off. Unemployment could spike. I don't know how high, but it could be significant. Think about how fast things deteriorated in 2008. In January of 2008, unemployment was 5%. By October of 2009, it was 10%. 5 percentage points in less than 2 years. Millions of people lost their jobs. Families lost their homes. Retirements were destroyed. I'm not trying to be alarmist, but I am trying to be realistic. These are the stakes we're dealing with. Now let me explain what I'm doing personally. How I'm positioned for what I believe is coming. First, I'm holding a significant amount of cash. More than I normally would. I want liquidity. I want to be able to move quickly when opportunities appear. And opportunities will appear. During the financial crisis, when everyone was panicking and selling, I was buying. I made some of my best investments in late 2008 and 2009 because assets were so cheap. The same thing will happen if we get a banking crisis. There will be incredible bargains for people who have cash and courage. Second, I'm very selective about where I keep that cash. I'm using large, systemically important banks, JP Morgan, Bank of America, the too big to fail institutions. I know people criticize these banks, and I'm no fan of bailouts, but pragmatically, these are the safest places to keep cash during a banking crisis. The government will not let them fail. Smaller banks might fail. Regional banks might fail. But the biggest banks have implicit government guarantees. That's just the reality. Third, I'm short certain regional bank stocks. I'm not going to tell you which ones because I don't want to move the market. But I've identified the most vulnerable institutions and I'm betting against them using put options and short positions. If I'm right about this crisis, these positions will be very profitable. If I'm wrong, I'll lose money on these bets. But I'm confident enough in my analysis that I'm willing to take that risk. Fourth, I own gold. Physical gold, not paper gold. I have it stored securely. Gold has always been a safe haven during financial crises. When banks are failing, when the stock market is crashing, when people lose faith in the financial system, they turn to gold. It's been that way for thousands of years. I don't expect that to change now. Fifth, I'm looking at distressed debt opportunities. When companies get into trouble, when they can't refinance their loans, their bonds trade at big discounts. If you can identify companies that will survive the crisis, buying their debt at 50 or 60 cents on the dollar can generate excellent returns. This is contrarian investing. You're buying when everyone else is selling. It takes nerve and it takes analysis, but it can be very profitable. Sixth, I'm staying away from commercial real estate entirely. I don't own any REITs. I don't own any office buildings. I don't own any retail properties. The values are going to keep falling. The rents are going to keep falling. The cap rates are going to keep rising. There's no reason to catch a falling knife. I'll consider getting back into commercial real estate when the crisis is over and valuations are attractive again. But right now, it's a disaster waiting to happen. Now, let me address the counter-arguments, because I know people will say I'm being too pessimistic. Some will argue that banks are much better capitalized than they were in 2008. And that's true. Capital ratios are higher. Tier 1 capital is stronger. The banks did build up their reserves after the financial crisis. But capital doesn't help if depositors run. Silicon Valley Bank had good capital ratios. They still failed in 2 days because of a deposit run. Capital is important, but liquidity is what matters in a crisis. Some will argue that the Fed will step in and prevent any crisis. They'll extend their lending facilities. They'll provide unlimited liquidity. They'll backstop the banks. And maybe they will. But even if they do, there will be damage. The Fed can prevent total collapse, but they can't prevent a recession. They can't prevent loan losses. They can't prevent a credit contraction. At best, they can put a floor under how bad things get. That's not the same as preventing problems. Some will argue that I've been predicting crashes for years and they haven't happened, so why should anyone listen to me now? And it's true. I've been warning about various risks for a long time. I warned about the everything bubble. I warned about meme stocks. I warned about crypto. Some of those warnings played out, some haven't yet. But here's the thing, with the banks, I'm not making a vague prediction about systemic risk. I'm pointing to specific vulnerabilities in specific institutions with specific catalysts that could trigger specific problems at a specific time. This isn't crying wolf. This is pointing at a wolf that's already at the door. Let me tell you about another time I was early and how it felt. After the financial crisis around 2010, I started warning about sovereign debt problems in Europe. I looked at Greece, at Spain, at Italy, at Portugal. I saw countries with massive debts, uncompetitive economies, and no ability to devalue their currencies because they were in the euro. I knew there would be a crisis, but the crisis took a while to develop. For a year, people thought I was wrong. Greek bonds kept trading at reasonable prices. Spanish bonds looked fine. Everyone said the European Central Bank would handle it, that the Eurozone would never allow a member to default. And then in 2011, the crisis hit. Greece did default, effectively. Spanish and Italian bonds sold off massively. The ECB had to intervene with unprecedented measures. The Eurozone almost broke apart. I was proven right, but I endured a year of people thinking I was wrong. That's the nature of this kind of analysis. If you can see the crisis coming, you're early by definition. If you wait until everyone else sees it, it's too late to position yourself. So, yes, I might be early on this banking crisis. Maybe it doesn't start in March. Maybe it's April or May or June. Maybe the Fed does extend their facilities and that buys more time. Maybe somehow the commercial real estate situation stabilizes. But I don't think so. I think the vulnerabilities are too severe. The stresses are too great. The structural problems are too deep. Something is going to break. And when it does, it's going to happen fast. Let me share one more historical example that I think is instructive. In the 1980s, there was a savings and loan crisis. For those too young to remember, savings and loans were like small banks that focused on home mortgages. In the 1980s, interest rates spiked. The S&Ls were stuck holding long-term mortgages at low rates while having to pay higher rates to depositors. Their net interest margins collapsed. They became insolvent. But the government didn't shut them down right away. They engaged in regulatory forbearance. They let zombie S&Ls keep operating even though they were technically bankrupt. And you know what those zombie S&Ls did? They made increasingly risky loans trying to gamble their way back to solvency. They took huge risks because they had nothing to lose. And when those risky loans failed, the losses were even bigger. By the time the government finally resolved the crisis in the late 1980s and early 1990s, over 1,000 S&Ls had failed. The cleanup cost taxpayers over $130 billion. I see parallels to today. Regional banks sitting on unrealized losses, that's like the S&Ls in the 80s. They're economically impaired even if they're technically solvent. And some of them are making risky loans trying to generate enough income to offset their problems. They're lending to increasingly marginal borrowers. They're stretching on credit quality. They're gambling. And when those gambles fail, the losses will be severe. The government is again engaged in regulatory forbearance. They're letting banks carry underwater bonds at par value. They're not forcing immediate recognition of commercial real estate problems. They're hoping things improve on their own. But hope is not a strategy. The longer they wait, the worse it gets. I published a piece several months ago outlining some of these concerns. The reaction was mixed. Some people got it. They understood what I was saying and they started adjusting their portfolios. But a lot of people dismissed it. They said banks are fine. The Fed has everything under control. I'm being unnecessarily negative. Those same people dismissed my warnings in 2005. They said housing prices never go down nationally. Lending standards are fine. The rating agencies know what they're doing. They were wrong then, and they're wrong now. Here's what I want you to understand. I don't enjoy being the bearer of bad news. I don't enjoy warning about crises. It would be much easier and more pleasant to be optimistic, to go along with the consensus, to say everything is fine. But that's not honest. And it's not responsible. If I see problems, if my analysis shows serious risks, I have an obligation to speak up. That's what I did in 2005. That's what I'm doing now. You can dismiss me. You can say, I'm always predicting doom. You can say this time is different, but I'd encourage you to do your own research. Look at bank balance sheets. Look at their securities portfolios. Look at their commercial real estate exposure. Look at their deposit compositions. Look at which loans are maturing in the coming months. Look at the data. Don't take my word for it. Draw your own conclusions. I spend my days reading financial statements, running models, analyzing risks. That's what I do. That's what I've always done. I read 500 pages a day, not because I have to, but because I want to, because I'm genuinely curious about how systems work and how they fail. And when I look at the banking system today, I see fragility. I see hidden risks. I see a crisis waiting to happen. The trigger could come in March. It could come later, but it's coming. The mathematics are inexorable. The structural problems can't be wished away. At some point, reality asserts itself. At some point, accounting games stop working. At some point, the market demands truth. And when that point comes, it happens fast. Bank runs happen in hours now, not days. Confidence can evaporate overnight. Once the crisis starts, it will be too late to protect yourself. So what should you do? First, know where your money is. If you have deposits over the FDIC insurance limit, consider spreading them across multiple banks or moving them to larger institutions. Second, make sure you have adequate cash reserves. Not invested. Actual liquid cash that you can access immediately. Enough to cover 6 months or a year of expenses. You don't want to be forced to sell investments at the bottom of a market crash because you need money. Third, if you own bank stocks, really look at the balance sheets. Understand what you own. Don't just hold them because they pay a nice dividend or because you've always owned them. Some bank stocks are going to zero in a crisis. Make sure yours aren't among them. Fourth, Consider your broader financial exposure. How much risk are you taking? Are you over-leveraged? Are you in a position where you can weather a significant market downturn? If not, maybe it's time to get more conservative. Fifth, think about opportunities. If a crisis does happen, there will be incredible buying opportunities. Assets will be cheap. Quality companies will be trading at bargain prices. If you have capital and courage, you can make a fortune. That's what I did in 2008 and 2009. That's what I plan to do if this crisis materializes. I'm not saying sell everything and hide in a bunker. I'm saying be prepared, be thoughtful, be realistic about risks. Don't assume everything will be fine just because that's more comfortable to believe. The most dangerous words in investing are, "This time is different." People said that before every crash. They said it in 1929. They said it in 2000. They said it in 2008. They were wrong every time. Things are never really different. Human nature doesn't change. Greed and fear don't change. The boom and bust cycle doesn't change. The specifics differ, but the underlying dynamics are always the same. Right now, we're near the end of a long credit cycle. Interest rates were artificially suppressed for over a decade. That created distortions. That encouraged excessive risk-taking. That inflated asset prices. Now, rates have normalized and the distortions are being exposed. The chickens are coming home to roost. The banking sector is where the stress is concentrated. That's not an accident. Banks are highly leveraged institutions that are extremely sensitive to interest rates. When rates rise sharply, as they have, banks get hurt. Their securities portfolios lose value. Their deposit costs go up. Their borrowers struggle to service debt. These problems don't appear immediately. They build slowly. But eventually they reach a critical point. And then things happen fast. I think we're approaching that critical point. I think March could be when we hit it. Maybe I'm wrong about the exact timing, but I'm not wrong about the vulnerabilities. They're real. They're documented. They're sitting there in black and white in bank financial statements. Anyone who takes the time to look can see them. Let me dig deeper into the specific mechanisms of how this crisis will unfold, because understanding the mechanics is crucial. When I was analyzing the subprime mortgage market in 2005, I didn't just see that housing was overvalued. I understood the specific transmission mechanism, how adjustable rate mortgages would reset, how borrowers would default, how the lower tranches of mortgage bonds would get wiped out first, then the middle tranches, then eventually even the AAA tranches. I understood the cascade. And that's what allowed me to structure my bets correctly, to know where to short, to know how to hedge, to know when to expect the crisis to accelerate. The same level of mechanical understanding is necessary now. Here's how a regional bank crisis propagates through the system. It starts with one bank getting into visible trouble. Let's call it Bank A. Bank A announces terrible earnings. Maybe they disclose that they're setting aside massive loan loss reserves for commercial real estate. Maybe they admit that their deposit outflows are accelerating. Maybe they announce they're suspending their dividend to preserve capital. Whatever the specific disclosure, the market reacts. The stock crashes. Credit rating agencies downgrade the bank. Analysts put out negative reports. The media picks up the story. Now, depositors at Bank A start getting nervous, especially the large depositors, the ones over the FDIC limit. They start withdrawing money, not all at once at first, but steadily. $1 million here, $5 million there. Bank A's liquidity starts declining. To meet these withdrawal requests, Bank A has to sell assets. They start with the most liquid assets first, maybe some treasury bills, some short-term securities. But as the outflows continue, they have to sell their longer duration securities, the ones that are underwater. And when they sell those, they have to recognize the losses. Those losses hit their capital ratios start declining. As the capital ratios fall, the rating agencies downgrade Bank A again. This spooks depositors even more. The withdrawal pace accelerates. Now Bank A is in a full panic. They're selling everything they can. But it's not enough. They approach the Federal Home Loan Bank for advances. They tap the Fed's discount window. These are emergency funding sources. But the market sees these moves, and it confirms everyone's worst fears. Bank A is in real trouble. The stock is now down 80% from its high. Depositors are running for the exits. Management holds an emergency conference call to reassure everyone. But it doesn't work. It never does. Words can't stop a bank run. Only cash can. And Bank A is running out of cash. By the weekend, regulators step in. They seize the bank, they arrange a sale to a larger bank, or they arrange an FDIC receivership. Bank A's equity holders are wiped out. Bondholders take haircuts. Uninsured depositors face uncertainty about whether they'll get all their money back. It's chaos. But here's where it gets really dangerous. Bank A's failure doesn't happen in isolation. There are other regional banks, Bank B, Bank C, Bank D, all with similar balance sheets, similar unrealized losses, similar commercial real estate exposure, similar reliance on uninsured deposits. And the depositors at these banks are paying attention. They watched what happened to Bank A. They don't want to be next. So they start withdrawing their money too. This is called contagion. Bank A's failure infects other banks. Even if Bank B and Bank C haven't done anything wrong, even if they're managing their balance sheets prudently, they get caught up in the panic. Depositors don't have time to analyze each bank individually. They make simple heuristic decisions. Is this a large, too big to fail bank? If yes, money stays. If no, money goes. It's that simple. So now Bank B and Bank C are facing deposit runs. They're forced to sell securities at a loss. Their capital declines. Rating agencies downgrade them. The spiral continues. Within days, multiple banks are in trouble. The regulators can't keep up. The FDIC doesn't have enough staff to handle simultaneous bank failures. The banking system is seizing up. At this point, the Fed is forced to intervene. They announce emergency lending facilities. They lower interest rates. They guarantee all deposits, even above the insurance limit. They're trying to stop the contagion. Sometimes these interventions work. Sometimes they don't. In 2008, the Fed and Treasury had to do extraordinary things. They had to bail out Bear Stearns, bail out AIG, let Lehman Brothers fail, which was a mistake, bail out Citi and Bank of America, inject capital into hundreds of banks through TARP. It was the most dramatic government intervention in the financial system since the Great Depression. And even with all that, the crisis still lasted for over a year. The economy still fell into a deep recession. Unemployment still spiked to 10%. It took years to recover. I think we're going to see something similar starting in March of 2026. The specific banks that fail might be different than I predict. The exact timeline might be off by a few weeks or months. But the general pattern, the cascade of failures, the contagion, the Fed intervention, the economic damage, that's all going to happen. I'm as confident of this as I was in 2005 that subprime mortgages were going to blow up. Let me tell you about the signals I'm watching most closely in the coming weeks. First, bank stock prices. If regional bank stocks start selling off hard, that's a warning sign. The equity market usually sees problems before regulators do. Stock prices incorporate information quickly. If investors are dumping bank stocks, they know something. Second, credit default swap spreads on banks. CDS spreads measure how much it costs to insure against a bank's default. When CDS spreads widen dramatically, that's a red flag. It means the bond market is getting nervous. The bond market is usually smarter than the equity market. Bond investors tend to be more sophisticated, more risk-averse. They're usually right. Third, the TED spread. This is the difference between what banks charge to lend to each other versus the Treasury bill rate. When banks trust each other, the TED spread is low, maybe 20 or 30 basis points. When banks don't trust each other, when they worry about counterparty risk, the TED spread blows out. It can go to 200, 300 basis points or more. A rising TED spread tells you banks are scared to lend to each other. That's a very bad sign. Fourth, deposit flows at regional banks. The Fed publishes weekly data on deposits at domestically chartered banks. If I see sharp declines in deposit levels at smaller banks, that tells me a quiet run is happening. It might not be making headlines yet, but depositors are voting with their feet. They're moving money to safer institutions. Fifth, usage of Fed emergency lending facilities. The Fed publishes data on borrowing from the discount window and from the Bank Term Funding Program. If I see borrowing spike, that tells me banks are under stress. They're running short on liquidity. They need emergency funding. Healthy banks don't borrow from these facilities. Only stressed banks do. Sixth, commercial real estate transaction data. If commercial property sales are drying up, if cap rates are spiking, if foreclosures are rising, that confirms the underlying problem. Commercial real estate is the collateral for a huge amount of bank lending. When CRE values fall, bank loans become underwater, losses mount. I'm monitoring all of these indicators daily. Some of them are already flashing yellow. Not red yet, but yellow. Warning signs are accumulating. The picture is deteriorating, and I expect it to accelerate in the coming weeks. Now, let me address some of the pushback I've gotten when I've shared these concerns privately with other investors. Some people say, Michael, you're forgetting that banks are much more sophisticated now about managing interest rate risk. They use derivatives to hedge their duration exposure. They stress test their balance sheets, they model out worst-case scenarios, and yes, that's all true. Banks do have better risk management than they did 20 years ago. But better doesn't mean good enough. Silicon Valley Bank had a risk management department. They had models, they had stress tests. They still failed in 48 hours. Why? Because models are based on assumptions, and assumptions can be wrong. SVB's models assumed that their deposit base was stable. That assumption was wrong. When depositors ran, the models became irrelevant. I've looked at the risk management disclosures of numerous regional banks. I've read the sections of their 10-Ks where they describe how they manage interest rate risk. And you know what I see? A lot of complex jargon that doesn't actually tell you anything useful. They talk about using derivatives to hedge their exposure, but they don't tell you exactly which derivatives, in what amounts, with what counterparties, with what collateral requirements. They talk about stress testing under various scenarios, but they don't tell you what those scenarios are, what assumptions they make, whether the scenarios are realistic. It's all vague reassurances designed to make you feel comfortable without actually providing useful information. This is what regulators require, and this is what banks provide, but it doesn't mean the risk is actually being managed well. Other people say, Michael, the Fed has learned from 2008. They know how to respond to a banking crisis now. They'll act quickly and decisively. They'll provide unlimited liquidity. They won't make the same mistakes. And again, there's some truth to this. The Fed does have more tools now. They have experience with crisis management. They know the playbook. But here's the problem. The Fed is constrained. They're constrained politically. They're constrained by concerns about moral hazard. They're constrained by inflation. They can't just bail out everyone the way they did in 2008. There would be a massive public backlash. People are already angry about inflation. They're angry about wealth inequality. They're angry about bailouts. If the Fed steps in and rescues a bunch of banks that made bad decisions, that paid their executives huge bonuses while sitting on massive losses, there will be political hell to pay. So the Fed will hesitate. They'll try to let some banks fail to maintain market discipline. And that hesitation will make the crisis worse. I saw this in 2008. The Fed and Treasury were inconsistent. They saved Bear Stearns, then they let Lehman fail, then they realized that was a terrible mistake and they saved everyone else. That inconsistency created panic because market participants didn't know who would be rescued and who wouldn't. Everyone assumed they might be the next Lehman. So everyone hoarded cash. Lending froze. The crisis intensified. I'm worried we'll see the same pattern again. The first bank that fails, maybe the Fed lets it fail to prove they're serious about not bailing everyone out. But then they realize the contagion is spreading, so they step in to save the next bank. But by then, the damage is done. Confidence is shattered. The crisis is underway. Some people say, Michael, you're ignoring the strength of the overall economy. Unemployment is low. Consumer spending is strong. GDP growth is positive. The economy can withstand some bank failures. And yes, the economy is stronger than it was in 2007. But that's exactly what people said then too. In 2007, before the crisis hit, everyone said the economy was fine. Unemployment was below 5%. GDP was growing. Sure, housing was weak, but housing was only 15% of the economy. The other 85% was fine. We kept hearing about how the subprime mess was contained. Well, it wasn't contained. Housing weakness spread to banks. Bank failures spread to credit markets. Credit problems spread to the real economy. Businesses couldn't get loans. Consumers couldn't get credit. Spending fell. Companies laid off workers. Unemployment spiked. The recession was severe. Economic strength is an illusion during the early stages of a financial crisis. Everything looks fine right up until it doesn't. Banks don't fail when the economy is already in recession. They fail when the economy seems strong but has hidden vulnerabilities. That's where we are now. The economy looks okay on the surface, but underneath there are massive problems. Commercial real estate is imploding. Banks are sitting on huge losses. Credit quality is deteriorating. Consumer debt is at record levels. Auto loan delinquencies are rising. Credit card defaults are increasing. These are warning signs. These are the early tremors before the earthquake. But most people ignore them because unemployment is still low and the stock market is still near all-time highs. They're looking at lagging indicators while ignoring leading indicators. Let me share another historical parallel that I think about often. In the 1970s, there was a bank called Franklin National Bank. At the time, it was the 20th largest bank in the United States. It got into trouble because of bad loans, foreign exchange losses, and fraud. In May of 1974, the Fed stepped in to provide support, but the support wasn't enough. In October of 1974, Franklin National was declared insolvent. It was the largest bank failure in U.S. history at that time. The failure sent shockwaves through the banking system, but it didn't trigger a broader crisis. Why not? Because the problems were isolated to Franklin National. Other banks were healthy. The Fed's intervention was sufficient to contain the damage. That's the best-case scenario for what happens in March. One or two banks fail. The problems are isolated. The Fed contains it. Markets are rattled, but they recover. It's painful, but it's not catastrophic. But I don't think that's what we're going to see. Franklin National was an isolated case of mismanagement and fraud. What we have now is a systemic problem. Hundreds of banks are sitting on unrealized losses. Hundreds of banks have commercial real estate exposure. Hundreds of banks rely on uninsured deposits. This isn't one bad apple. This is a structural problem with the entire regional banking sector. And structural problems don't get resolved with targeted interventions. They require massive systemic interventions. They require policy changes. They require recapitalization of large parts of the banking system. That's much harder to do, much more expensive, much more politically fraught. Let me talk about what this means for different groups of people, because the impact will vary depending on your situation. If you're a depositor at a regional bank, you need to think very carefully about your exposure. If you have more than $250,000 at a regional bank, especially one with significant commercial real estate exposure, consider moving some of that money. I know it feels awkward. You've banked there for years. You know the branch manager. You trust them. But banks fail. It happens. And when it happens, uninsured depositors face losses or, at minimum, long delays in accessing their funds. It's not worth the risk. Move the excess to a large bank or spread it across multiple institutions to stay under the insurance limit. If you're a small business owner, think about your credit lines. If you have a line of credit with a regional bank, draw it down now. Take the cash and put it somewhere safe. When a banking crisis hits, credit lines get cut, banks stop lending. Even if you have an established relationship, even if you've never missed a payment, they'll reduce your line or eliminate it entirely. They need to preserve capital. They need to reduce risk. Your business's needs don't matter to them when they're fighting for survival. So draw the line now while you can. If you're a real estate investor, especially in commercial real estate, understand that you're in the danger zone. If you're holding office buildings or retail properties, values are going to keep falling. If you have loans coming due in the next year, you might not be able to refinance. You might have to sell at a loss or hand the keys back to the bank. Think about your exit strategy now. Can you pay down debt? Can you improve occupancy? Can you sell before things get worse? Don't wait and hope. Hope is not a strategy. If you're a stock investor, think about your bank exposure. Do you own regional bank stocks? Do you own bank ETFs? These are going to get hammered in a crisis. Even good banks will sell off because investors won't be able to distinguish between the strong and the weak. It all goes down together. consider reducing your exposure or hedging with put options. If you're heavily invested in stocks generally, think about whether you have the stomach for a major downturn. The S&P 500 could easily drop 30 or 40% in a banking crisis. Can you handle watching your portfolio lose a third or more of its value? If not, maybe it's time to become more defensive. Raise some cash, shift some money to bonds or money market funds. You don't have to sell everything, but having some dry powder, having some stability in your portfolio, that gives you options. That gives you the ability to buy when others are panicking. If you're a young person just starting your career, a banking crisis is actually an opportunity. Yes, it's scary. Yes, the job market might get tougher, but it's also when assets get cheap. If you can keep your job through the crisis, if you can keep saving and investing, you can buy stocks at bargain prices. You can buy real estate at depressed valuations. The wealth you build by investing during a crisis will compound for decades. Some of the best investors I know built their fortunes by having courage during previous crises. If you're retired or near retirement, you need to be defensive. You don't have time to recover from major losses. You can't afford to lose 30 or 40% of your portfolio value. Make sure you have enough safe assets, cash, short-term bonds, money market funds, to cover at least 5 years of expenses. That way, even if stocks crash, you don't have to sell at the bottom. You can live off your safe assets while waiting for your stocks to recover. This is basic, but it's important. Too many retirees are overexposed to stocks. They've been reaching for yield, they've been chasing returns, and they're going to get hurt if a crisis hits. Let me talk about what I'm not doing, because that's just as important as what I am doing. I'm not panicking. I'm not selling everything and hiding under my desk. I'm not predicting the end of the world. A banking crisis is serious, but it's not apocalyptic. The U.S. economy is resilient. American businesses are innovative. The country will get through this. We got through 2008. We got through the 1990s savings and loan crisis. We got through the 1980s Latin American debt crisis. We got through the Great Depression, for crying out loud. We'll get through this too. But getting through it doesn't mean avoiding all pain. It doesn't mean your portfolio won't take a hit. It just means that on the other side, life goes on. The economy recovers. Markets recover. Opportunities emerge. I'm also not timing this to the day or week. I don't know if the crisis starts on March 3rd or March 24th or April 15th. What I know is the vulnerabilities are there. The stresses are building. Something is going to give. Maybe my March timing is wrong. Maybe it's later. But that doesn't invalidate the analysis. The problems are real, regardless of exactly when they manifest. I'm not trying to short every bank. I'm selective. I'm focused on the most vulnerable institutions, the ones with the worst commercial real estate exposure, the ones with the most reliance on uninsured deposits, the ones with the biggest unrealized losses relative to capital. Those are the ones that will fail first. I'm not worried about JP Morgan or Bank of America. They'll be fine. They might take some hits. Their stocks might go down. But they won't fail. They're too big. They're too diversified. They have too much capital. They have access to unlimited Fed liquidity if needed. My shorts are focused on smaller banks, where the risk-reward is much more favorable. I want to share one more story about the 2008 crisis because I think it illustrates an important point. In September of 2008, after Lehman failed, the entire financial system was frozen. Nobody would lend to anyone. The commercial paper market seized up. Companies couldn't roll over their short-term debt. Even blue-chip corporations, companies like General Electric, were having trouble funding themselves. It was terrifying. I remember talking to CEOs of major companies who were genuinely worried they might not make payroll the next week, not because their businesses were failing, but because they couldn't access credit. The plumbing of the financial system had broken down. And into that panic, there were opportunities. Stock prices had collapsed. Good companies were trading at absurd valuations. If you had cash and courage, you could buy companies at 5 or 6 times earnings. Companies that normally traded at 15 times earnings. The fear was so extreme that people were giving away assets. I didn't buy as much as I should have. I was too cautious. I was worried things would get even worse, but I did buy some. And those investments turned out to be some of the best I ever made. They compounded at enormous rates over the next decade. The point is, crises create opportunities. Yes, they're scary. Yes, they're painful. But they're also when great fortunes are made. The key is being prepared, having cash, having a clear head, being able to analyze value when everyone else is panicking. That's what I'm positioning for now. I'm preparing for the crisis, but I'm also preparing for what comes after. The recovery, the opportunities, the chance to buy great assets at bargain prices. That's the game. That's how you build wealth over the long term. You protect capital during the bad times. You deploy capital aggressively during the crises, and you let your investments compound during the good times. It's a simple formula, but most people can't execute it. They do the opposite. They get greedy during booms and fearful during busts. They buy high and sell low. They destroy wealth instead of building it. I've spent my entire career trying to do the opposite. Trying to be fearful when others are greedy, and greedy when others are fearful. To quote Warren Buffett, who despite our philosophical differences, got that part exactly right. And right now, we're in a period where others are complacent. They think everything is fine. They think the Fed has everything under control. They think banks are safe. So I'm being fearful. I'm preparing. I'm reducing risk where I need to. I'm building short positions where I see vulnerability. And I'm holding cash so I can be greedy when the crisis hits. The question for you is, what are you going to do? Are you going to be prepared, or are you going to be caught off guard? Are you going to protect yourself, or are you going to hope everything works out? Are you going to be proactive, or are you going to be reactive? These are choices you need to make now, not when the crisis is already underway. Because once it starts, it will be too late. Once depositors are running, once banks are failing, once markets are crashing, you can't make rational decisions. The fear is too intense. The losses are too painful. You'll make emotional choices that hurt you. But if you prepare now, if you think through your strategy now, if you position your portfolio now, then when the crisis hits, you can stay calm. You can stick to your plan. You can even take advantage of opportunities as they emerge. That's the difference between being prepared and being caught off guard. So I'm telling you now, March is coming. The banking crisis is coming. The warning signs are there for anyone willing to look. The question is, will you look? Will you act? Or will you ignore this like most people ignored my warnings in 2005? The choice is yours.